What if robots weren't just working behind closed doors on assembly lines, but were right there serving you your coffee, delivering your room service, or even mixing your next cocktail?
Hmm.
And what if there's a company out there right now, squarely focused on building that future in the service industry?
It's a compelling vision, isn't it? The potential for automation to really change how we experience everyday services.
Yeah, and maybe tackle challenges like labor shortages head on.
Exactly. And that brings us to today's deep dive. We're digging into one such company, Richtech Robotics, Inc. Trades on the NASDAQ, ticker RR.
Right. We've pulled together a stack of sources, articles, research reports, financial data, and our mission is to really unpack all of it for you.
We're looking at the nuts and bolts of the business, the management team, the financials, and all the risks swimming around.
And we'll filter it all through a lens inspired by value investors, thinking about what's most important for you to understand in this complex picture.
Think of us as going through this information together, identifying the crucial insights and connecting the dots.
Absolutely. Now, as we jump into this material, we want to share something mentioned directly in one of our sources right up front. Remember to like and subscribe to the stockanalytics.ai YouTube channel.
Yes. And for members at the Euro 499 a month level, you can give them the ticker and get a prioritized deep dive analysis or post-earnings review, just like this one.
It's a way to get targeted analysis on companies you care about fast.
Definitely. And by the end of this deep dive, we're going to leave you with a key question about Richtech's path forward.
Yeah, one that we think really gets to the heart of their story and is well worth mulling over.
It touches on whether their ambitious plans can genuinely outrun the significant financial hurdles they face right now.
Okay, let's unpack this. Let's start with the business itself. Richtech Robotics, RR, what's their core focus?
Richtech is a Nevada-based company. They develop, manufacture, and deploy AI-driven service robots.
Service robots, okay.
Yeah, specifically targeting sectors like hospitality and healthcare, aiming to help businesses cope with labor shortages, boost efficiency, that kind of thing.
And this isn't a small niche they're playing in, is it? I mean, the market for robotics seems huge.
Not at all. The sources highlight they're part of the global advanced robotics market. It's already big, over $53 billion this year.
Wow.
And projected for massive growth, maybe hitting over $280 billion by 2034.
That's huge growth.
It is. That's a compound annual growth rate north of 20%. And the service and hospitality segment is pointed out as a key area driving a lot of that expansion.
So they're in a rapidly growing market. What specific kinds of robots are they putting out there? I think I've heard about robot baristas.
Yes, the Atom. That's their AI-powered robot barista. Makes coffee, espresso drinks.
Using NVIDIA AI, right?
That's right. It uses NVIDIA AI technology, which is a recurring theme with their more advanced robots. You can see Atoms deployed in their own Cluffy and Tea locations and also through partnerships in some Walmart stores.
Okay, so AI baristas are a real thing. What else is in their lineup?
Well, there's a Scorpion, another AI-driven beverage robot, also NVIDIA tech, but this one's a single-arm robot built for bartending.
Bartending. Interesting.
Yeah, they actually recently secured a distribution deal for 500 Scorpion units over the next 5 years.
500 units, that's pretty significant.
It's a notable volume commitment.
Yeah.
Beyond beverages, they have Matrady robots for server assistants in restaurants.
Okay.
Medbot, designed for hospital deliveries, can even use elevators. Titan for heavy-duty transport, Skylark for hotel room service, and the DSTE series for cleaning.
That's quite a range of robots, different service tasks. Their tech edge seems to lean heavily on AI and collaborative robotics. What does that NVIDIA partnership mean for them, really?
It's a bit of a double-edged sword, based on the sources.
How so?
Well, on one hand, it gives them access to really cutting-edge AI platforms from a leader in the field. That's essential for their robot's intelligence.
But the downside?
Dependency.
Yeah.
It creates dependency. If something changes with NVIDIA's tech or pricing or availability, it could impact Richtech significantly.
So their advantage might be more in how they use the AI, not the AI itself.
Exactly. How well they integrate and apply this AI in specific service robot use cases, rather than maybe developing the core AI tech themselves.
Got it. Now, the sources talk about a significant shift in their business model. They're moving away from just selling robots up front, right?
Correct. This is a fundamental transition for the company, moving towards robotics as a service, or RAIS.
RAIS, okay.
The traditional approach was, a one-time sale. Immediate revenue. The RAS model is based on subscriptions or leases.
Aiming for that recurring revenue stream.
Precisely. Like software as a service, but with hardware involved. The goal is more predictable, ongoing revenue, attractive long-term.
But it sounds challenging now.
It definitely presents significant challenges right now, as the sources detail. It changes how they recognize revenue short-term, less upfront cash.
Right.
It requires Richtech to bear the cost, carry those deployed robots on their balance sheet.
Yeah.
That demands more capital upfront.
And they need the support infrastructure, too.
Absolutely. They need to build out a robust, responsive service and support infrastructure to keep the robots running smoothly. That's complex and costly.
So more operational complexity overall.
Definitely more than just selling a box.
Yeah.
And they also have another revenue stream, right? Running some robot locations themselves.
Yes, so a subsidiary called AlphaMax Management. They operate sites like Clufeon Tea Shops and some Walmart One kitchens.
Kind of like vertical integration.
Exactly. It's a way to showcase their tech in the real world, maybe learn from operations. But it also means they're taking on the risks and headaches of running food and beverage businesses.
Interesting layer. So where are these robots actually deployed now? And who are they really up against?
Sources mentioned over 350 robot deployments in the U.S., some recognizable names using them: Texas Rangers, Golden Corral, Hilton, Sodexo, Boyd Gaming, Walmart.
Okay, some big names. But the competition.
Described as intense and fragmented, you've got massive industrial automation giants like ABB, Fanuc, KUKA moving into service robot.
The big players.
Plus a host of smaller, specialized players. Richtech is, well, quite small relative to these larger companies.
Are there high barriers to getting into this service robot market? Or is it easy for anyone to jump in?
The sources suggest significant barriers. Substantial R&D costs, needing highly skilled workers, the difficulty of integration into existing workflows, safety compliance, ongoing support.
So it's not easy, but it's still crowded.
Seems that way. The implication is Richtech is in a tough race. They need to successfully scale manufacturing. They're planning a 400% expansion, which is huge.
400%, wow.
Yeah, and build out their support network while constantly innovating against larger players and maybe more agile startups using similar core tech.
Okay, let's talk about the economic moat, that sustainable competitive advantage. Based on the sources, does Richtech Robotics have a strong one right now?
Based on the information provided, it doesn't appear to have a wide, durable moat currently. Potential sources exist, but they seem limited at this stage.
What are those potential sources they might be trying to build? What could become a moat?
Well, they have intellectual property, over 11 patents cited, though one specific example mentioned is a design patent for appearance, which protects the look, not necessarily core tech.
Okay, design patents are less powerful usually. What else?
Their technology and innovation, particularly the AI aspect in that NVIDIA partnership, could be a factor. But we noted the NVIDIA reliance is a dependency risk.
Right.
They are building a brand, maybe establishing an early mover position in some niches, and partnerships like Walmart or distribution deals offer valuable channels.
But why isn't that adding up to a strong moat yet? What's missing?
Because they are currently unprofitable. They're heavily reliant on external capital to fund everything.
Running cash.
Exactly. Their scale is still small compared to competitors, and the market is intensely competitive, especially if others can access similar advanced AI, so their current advantages could be challenged.
Fair enough. So knowing all that, what's their stated long-term strategy to grow and build this business? Where are they trying to go?
It's centered around scaling up significantly and evolving the model. A major focus is that manufacturing and operational expansion, the 400% capacity increase, is key.
Tied to buying property in Vegas for the HQ.
Yes, tied to purchasing property for a new Las Vegas HQ. Sources note this signals confidence, but it also commits significant capital.
A big bet for a company losing money.
It is. They've also got an R&D office in Newark, California, near Silicon Valley for AI work. Adds complexity, cost.
Are they looking beyond the U.S. too?
Yes, global expansion is part of the picture. Participating in international trade fairs like ProWine in Germany in 2025.
Okay. What about R&D spending?
R&D is slated for continued investment, although it's worth noting a recent decrease in actual R&D spending year over year in the first half of FY25.
That's interesting for a tech company, decrease in R&D.
Yeah, something to keep an eye on. They also have an accelerator program with Columbia University. The Reyes business model shift is fundamental to their recurring revenue goal.
And they mentioned strengthening the domestic supply chain.
Right, stated commitment to strengthening the domestic supply chain, increasing U.S. assembly. Relevant when we talk about risks like tariffs later. Their overarching vision is pretty ambitious: to pioneer a harmonious future where humans and robots work in tandem.
Okay, lofty goals. So why should you, the listener, care about all this business detail? Why start here?
Understanding their market, their products, and especially that big ROAS transition is crucial. It explains why their financial picture looks the way it does right now.
Right, the costs and the revenue recognition changes from that shift are significant.
And knowing who they're competing against and assessing their current, let's say, lack of a strong moat helps you evaluate the sustainability of their position and the long-term viability of their plans. It sets the stage.
Makes sense. Okay, the business structure and strategy are one thing, but who is actually steering the ship? Let's look at management and ownership.
The key leaders mentioned include the co-founders. Wayne Huang, the CEO. 20-plus years in computer vision tech R&D focus. Michael Huang is the CFO, overseeing finance supply chain.
Okay, the Huangs. Who else?
Then there's Matt Casella, the president. Handles corporate strategy, financing IR. He's got a CFA level 2, brings that financial background. And Phil Zhang is the COO in charge of sales, ops, customer success. Interestingly, he has a legal background, a JD.
A JD for the COO.
Yeah.
That could be useful, especially with RES, contracts, regulations, that kind of complexity. What's their track record look like so far?
Well, successes. They navigated the IPO late last year, deployed those 350-plus robots, secured some notable clients, and they're pushing forward with that big manufacturing expansion.
Okay, some wins. Flip side.
Balanced against a track record of consistent unprofitability, negative cash flow, and periods of, let's say, inconsistent revenue or missed expectations since going public.
How transparent are they generally about the risks and challenges?
Sources note they do disclose risk factors extensively in filings. They have a code of ethics, suggests some candor about the challenges, which is a positive governance sign.
What about their decisions on spending money? Capital allocation, is it rational?
They're definitely making bold, high capital commitment bets, spending significantly on R&D and especially that expansion, including buying property for the new HQ.
All right, buying versus leasing. Big move when you're burning cash.
Exactly. Signals conviction, maybe saves long-term, but commits cash now. The strategic shift to RIAS also makes sense conceptually for long-term revenue. But, and this is key, they are funding these plans predominantly through equity financing, selling shares.
Dilution. Which brings us to ownership and how that impacts shareholders like you. What do the sources say about insider ownership? How much skin do they have in the game?
This area is a bit unclear based on the sources provided. There's conflicting data.
Oh, how so?
One source suggests a very high 44.7% total insider ownership, CEO holding over 26%. But other sources report significantly lower figures, like 2.5% or maybe 13.4%.
Wow, that's a big discrepancy. Why are the confusion?
The snippets lack clear, consistent detail directly from SEC filings. This uncertainty makes it hard to assess alignment between management and public shareholders. High ownership can be good, but the conflicting info is a concern.
And have any insiders been selling shares recently?
Yes, this is noteworthy recent activity highlighted. President Matt Casella sold 60,000 shares in March 2025. One source says this brought his direct holdings down to 0.
0, okay. Anyone else?
Also, King Bliss Ltd., identified as a 10% owner, sold a substantial 2.2 million shares back in August 2024.
And any insider buying reported?
One source points out no reported insider purchases in the last 12 months. Now look, people sell stock for personal reasons, sure, but significant sales, especially by key execs or major holders, with no buying. Well, it's a data point worth noting for you.
Definitely. And this connects directly to the major issue of shareholder dilution, right? You mentioned they fund things by selling stock.
Absolutely critical for you as an investor. Richtech is relying heavily on selling stock. They had the IPO, subsequent offerings, and they have an active $100 million at the market facility.
Meaning they can just sell shares into the market when they need cash.
Pretty much. The sources explicitly state shares outstanding grew by a substantial 66.7% in the past year alone because of this ongoing dilution.
67% increase in shares. Wow. That really impacts the value of existing shares.
It directly impacts your shares by reducing your proportional ownership and your claim on any future profits or assets. It's a major headwind for existing shareholders.
What about the corporate governance structure? Anything interesting there beyond ownership?
They have a board with the CEO and 3 directors identified as independent, standard committees, audit, compensation, nom-gov composed of independent directors, which is good practice.
Okay. Anything else?
However, they do have a dual-class stock structure.
Dual class. What does that mean for a shareholder like me holding the RR ticker?
They have Class A and Class B shares. The RR ticker on NASDAQ is for Class B. Typically, Class A shares are held by founders or insiders and carry way more voting power per share.
So founders keep control even if they don't own a majority of the equity.
Often, yes. It concentrates voting control, potentially limiting the influence of public Class B shareholders like you on key decisions. It's a governance feature often flagged as a concern.
Right, so evaluating management and understanding ownership is important because why should you care?
Their decisions on capital spending, like buying that HQ, their strategy, like RIAS, directly impact the business's future. How they manage funding needs and dilution directly hits your investment value.
And the ownership questions, the sales, the dual-class structure, they affect your understanding of control and alignment.
Exactly. It's about understanding the human element and control dynamics behind the ticker. Okay, let's get into the numbers. Financial health. How does it look?
As of late May 2025, share price around $2.18. Market cap is about $250 million. Small cap territory suggests higher volatility.
And about 115 million shares out there now, reflecting that dilution.
Right. Roughly 114.8 million shares outstanding.
What's the picture like on the revenue side? Consistent growth.
It's been, well, inconsistent. Trailing 12 months revenue is around $4.4 million. The first half of fiscal 25 saw modest growth, up 6.7% year over year.
Okay, some growth there.
But zoom in on Q2 FY25, revenue is essentially flat year over year, 1.167 MO versus 1.165 MOs, and it missed analyst estimates.
Flat revenue. And looking back further,
Fiscal year 2024 revenue was actually a significant 51.59% decrease from fiscal 2023.
ouch, down over 50% year over year for FY24, so very bumpy.
Definitely bumpy.
Yeah.
While there are analyst forecasts for strong future growth, the current trend is showing that yet.
Okay, inconsistent revenue. Where do the significant financial challenges really show up? You mentioned unprofitability.
Profitability, yeah, this is where the numbers tell a stark story of significant cash burn. Now, they have relatively strong gross margins, TTM around 74.6%, FY24 was lower, 64%.
So the cost of making the robots themselves isn't the main issue. Good unit economics.
It suggests good unit economics before you factor in everything else, but their operating expenses have surged.
How significant is that surge?
In the first half of fiscal 2025, total OPEX was up a massive 137.5% year over year.
Whoa. What drove that?
The primary driver, according to the sources, was general and administrative expenses, G&A. Things like salaries, corporate overhead, admin, maybe marketing.
And how much did G&A increase?
It ballooned from $2.46 million to over $9.2 million in that same first half comparison.
Wow, a nearly $7 million jump in G&A in just 6 months year over year. Any insight into why? What's in there?
The sources don't give a detailed breakdown. It could be related to costs of being public, building out that RIAS infrastructure we talked about, maybe stock-based compensation or fees tied to expansion. Whatever the cause, it's dramatic.
And the result of that surge in expenses, what's the bottom line look like?
Widening net losses. Net loss in H1 FY25 was over $8 million, up from $3.8 million the prior year. Q2 alone saw a loss of $4.5 million, a 306% increase in the loss year over year. TTM net loss is over $12 million.
So margins are terrible.
Deeply negative operating and net margins, around negative 289% and mid 281% TTM. EPS in Q2 FY25 was negative $0.04. Missed estimates.
Okay, strong gross margins, but soaring G&A leads to big losses. Do they at least have a good cash buffer on the balance sheet?
They do have a fair amount of cash and short-term investments, over $41 million as of March 31st, 2025 in current assets. That provides a buffer.
And liabilities, debt.
Liabilities are very low, just $1.3 million total. Minimal financial debt, effectively debt-free from a borrowing perspective, which is a positive. Total equity around $55.8 million. Book value per share about $0.49.
And their liquidity ratios, current and quick, look fantastic on paper, don't they? Really high.
They do in the 70s, extremely high. However, and this is crucial context from the sources.
Uh-oh, what's the catch?
These high liquidity figures come directly from equity financing, from selling stock, not from generating cash from operations. The buffer exists, yes, but it's essentially investor cash that's being depleted by the operating losses.
Which the cash flow statement confirms, I assume.
Exactly. Reinforce the unprofitability picture. Negative operating cash flow, about negative $10.6 million TTM. Negative free cash flow, around negative $11.4 million TTM.
So the business isn't funding itself at all.
Not even close. It relies entirely on external capital raises to stay afloat and fund growth. And that planned CapEx for manufacturing expansion will likely increase the cash burn.
And return metrics like ROE or ROIC must reflect these losses.
Completely. Deeply negative TTM.
Wow.
Return on equity, negative 37.5%, ROIC, negative 22.9%, ROA, negative 22.6%. Capital invested is not generating positive returns yet.
You mentioned R&D spending earlier and noted a recent decrease. Can you remind us?
Yes, worth highlighting again.
Yeah.
H1 FY25 R&D spending actually decreased year over year, $0.8 million versus $1.2 million prior year.
So while G&A surged, R&D fell.
Right. For a tech company focused on innovation, that's a trend that needs careful monitoring by anyone watching the stock.
So stepping back, looking at these financials, what story does it tell you? What's the takeaway?
It paints a picture of a company with potentially good product economics at the gross level, but one currently burning significant cash due mainly for soaring operating expenses, especially G&A.
And the cash buffer is shrinking.
Right. And it's not being refilled by selling robots or services. It's being refilled by selling stock to investors, causing that dilution we talked about. The big question these numbers pose is, how long can that last?
That cash burn and reliance on financing makes the market's current valuation really interesting. How is Richtech being valued right now?
At that $2.18 share price, $250 million market cap.
Yeah.
The traditional valuation ratios look very stretched or are negative due to losses.
Like price to book.
Price to book is around 4.45 times its book value. But the price to sales ratio, that stands out dramatically. It's extremely high, about 56.9 times trailing 12 months revenue.
57 times sales. What does a number like that signal? That seems astronomical.
It signals the market is absolutely assigning a valuation based on massive future growth expectations,
Yeah.
completely divorced from current financial performance or asset value.
Just pure hope baked in.
Pretty much. The market isn't valuing what Richtech is now. It's betting heavily on what it hopes Richtech will become. This is drastically higher than peer or sector averages, which are often in the low single digits for PS.
So for a traditional value investor looking for intrinsic value based on current fundamentals, there's no real case here. It doesn't compute.
Precisely. The sources discuss DCF analysis yielding negative values based on current financials. Trying to justify the current valuation requires making highly speculative, optimistic assumptions about the future.
No traditional margin of safety.
None based on proven earnings or assets. An investment here is fundamentally a bet on highly uncertain future success and market disruption, not traditional value.
What about the analysts covering the company? What are they saying is their consensus?
Coverage is limited, maybe one or two analysts, but the consensus appears to be strong buy. Price targets notably above the current price, maybe $3 to $3.50, averaging around $3.25.
That sounds bullish, but you're saying these targets are speculative, built on hope.
Yes, almost certainly based on projections assuming successful execution of growth plans, achieving RaaS adoption, getting costs under control, moving to profit. They cater more to growth or speculative investors.
And what's fascinating here is the significant short interest in the stock. Lots of people betting against it.
This is a really key indicator of market skepticism. Sources report high short interest, around 18.99% of the public float.
Nearly 19%. That's substantial.
Yeah, about 11.7 million shares being bet against by investors expecting the price to fall. Days to cover is low, but that percentage is high. Cost to borrow shares is also up there, 5.8%. High off exchange short volume too.
So a large segment of the market actively believes the stock is overvalued or faces significant problems.
Exactly. Significant skepticism about their ability to live up to the valuation or overcome the challenges. It makes it a battleground stock. Adds volatility risk.
Could go either way, squeeze up or sell off hard.
Right. Potential short squeeze on good news, but also consistent selling pressure from the bears.
Why should you, the listener, pay attention to these valuation ratios and the short interest? What do they tell you?
They give you insight into how the market collectively feels. That extremely high PS shows immense optimism for the future. The high short interest reveals significant skepticism about that future or the current price. Understanding these conflicting signals helps you gauge the risks and potential rewards currently baked in.
All right, let's bring it all together. What's the overall picture of Richtech Robotics based on this deep dive viewed through that value lens?
Richtech Robotics is clearly innovative, operating in a high-growth industry with compelling AI robots. However, based on the source material, and particularly through a traditional value investing framework, It presents as a highly speculative investment opportunity at its current valuation.
How does it measure up against, say, those classic Buffett-inspired principles? Does it tick any boxes?
Well, the industry has favorable prospects, yes, but the company's specific prospects within it are uncertain competition, execution risk, the Reyes shift.
Management.
Management has vision, making bold moves, but an unproven track record on achieving sustainable profit and positive cash flow.
And the moat and valuation?
Critically, no discernible, durable economic moat right now. And the valuation's extremely high, based entirely on future hope, not present reality or a clear margin of safety.
So the key takeaway is it's not a traditional value play, not for the cautious investor.
Precisely. It does not fit traditional value criteria favoring proven profitability, moats, stability, reasonable price. RR is currently a play for investors with high risk tolerance, betting on a disruptive future vision.
If someone is interested, maybe has that higher risk tolerance, what are the most critical things you should be watching going forward? What needs to happen?
Several factors are absolutely crucial. Look for concrete evidence of Reyes adoption accelerating, translating into consistent, accelerating revenue growth.
Not just flat revenue.
Right. Track progress towards actual profitability and positive free cash flow. Pay close attention to whether they get that surging G&A expense under control relative to revenue.
Okay, profitability is key. What else?
Watch for successful, cost-effective execution of that 400% manufacturing scale-up. Keep a very close eye on ongoing capital needs and further shareholder dilution.
Dilution again.
Always. Monitor how they fare against competitors. Secure competitive wins. And watch external factors like those potential tariffs and evolving regulations.
Tariffs. Let's touch on that risk specifically. The sources mention U.S. tariffs from 2025. How could that impact Richtech?
It's a significant geopolitical risk outlined. Tariffs could raise costs for imported components, sensors, processors, things that's essential for the robots.
Increasing their cost of goods sold.
Exactly. Could increase KGS, put pressure on pricing. Do they absorb cost or pass them on, hurting competitiveness? Could also disrupt supply chains, maybe even hamper that manufacturing expansion if key parts get delayed or too expensive.
Are they doing anything about it?
They state an emphasis on U.S. assembly and increasing U.S. source materials for Atom and Scorpion.
But that takes time and might cost more too, right? Finding domestic suppliers.
Correct. It's not an easy or quick fix,
Yeah.
and U.S. parts can be more expensive. So the tariff uncertainty adds another layer of risk that could negatively impact stock value.
Okay, that's a lot to keep track of. Let's leave you, the listener, with that provocative thought we hinted at earlier.
Could Richtech's bold bets, the Reyes model, that massive manufacturing expansion, could they succeed and allow them to generate enough revenue and efficiency to finally outrun the cash burn?
Reach.
Sustainable profitability before exhausting capital.
Or will the constant need for external financing and the resulting shareholder dilution limit its ultimate potential before they truly get there?
And can they genuinely build a sustainable, defensible position against giants and startups if they're relying on similar core AI tech from external partners like NVIDIA?
Big questions for a company with very big ambitions.
Indeed. It's a fascinating case study, taking innovative tech and trying to make it a sustained, profitable business in a tough market.
And as we wrap up this deep dive, remember the callouts from our source material.
Like and subscribe to the stockanalytics.ai YouTube channel.
And members at the Euro 4.99 a month level, you can give us a ticker and get a prioritized deep dive or earnings analysis just like this one.
Now, as always, a few important disclaimers based on our source material.
This report is not financial advice. All investment decisions should be made with the help of a professional financial advisor and based on your own research and due diligence.
This report is generated by an AI model utilizing available research data and is intended for informational and educational purposes only. While efforts have been made to ensure accuracy based on the provided information, no guarantee of completeness or correctness is made.
All financial data, stock prices, and market information discussed are as of May 23, 2025, unless otherwise explicitly stated. Market conditions and company financials can change rapidly.
Investing in securities, particularly small cap and speculative stocks like Richtech Robotics, Inc., involves a high degree of risk, including the possible loss of principal.
Do your own research before making any investment decisions.
We hope this deep dive provides a valuable starting point for your own exploration of Richtech Robotics and the really interesting service robot space.